So let's look at what it takes, the steps that it takes to invest properly, to invest effectively in growth stocks. So the first thing that you need to do is get comfortable with a growth approach. Now, a growth approach is going to look a lot different than a value approach because a value approach, again, is you're trying to find something that is a bargain, something that is a discount, and buy it and then let it increase in value to what it is actually worth. Whereas your growth approach differs quite a bit. But you need to get comfortable with thinking about stocks in this way, thinking about companies in this way. You have to get comfortable with looking at companies and saying, what does the future hold? Being a bit of a visionary, right? We don't know for sure what the future is going to hold, but being able to look at industries and companies and saying, how is their growth going to be affected in the future based on, what the economy is doing, where the society is going, where the industry is going, and understanding where you can get certain upside based on future growth potential. And what is critical is that you choose one approach and you stick to that approach, because if you are floundering around trying to figure out, okay, is this a value or growth, or do I need to find a margin of safety or future growth rate or whatever, then you can get very confused and make some bad decisions in the future. And so anytime you're just trying to change your approach just so you can make the best returns, right? Because we know that the market goes through cycles. It goes through cycles of value winning and growth winning, and value winning and growth winning. And the best way to make sure that you don't make money in the stock market is to try to switch approaches when the market switches approaches. You are chasing returns if you are switching up approaches constantly. So stick with one, understand what you're doing. And if you are going to stick with the growth one, then there are some things that you have to understand about companies. Now, when you are selecting stocks, right, it is risky, right? It is risky to select growth stocks. It's risky to select stocks that don't have a proven track record, that don't have this long-term showing of success and proof of success like certain value companies do. But what you want to do when you're investing in growth stocks is you want to screen for certain different characteristics of stocks. So again, I've told you about how you would look for a value stock. Let's talk about how you would look for a growth stock. So you want above average growth in earnings or the profits that the company generates each year. Okay. So we talked about with value companies, you want the stability of earnings and consistent profitability. And with this, we're looking at above average growth of earnings. Okay, so we may not be where we want to be earnings wise just yet, but are they growing faster than usual? Then you want to look at above average profitability. And when I say profitability, we are talking about operating margins. We're talking about net profit margins, things like that, where the company is getting to keep a lot of their profits. They're going to keep a lot of their revenues because they don't have high costs. And so that will allow them to grow faster into the future. Therefore, look for high profitability margins. And then high historical growth in revenue or sales. So again, this contrasts with the value approach because we're looking for the stable sales. We're looking for stability within our revenues. But now we're looking for high growth in revenue or sales, which is no surprise. And then you want high return on invested capital, which this is an efficiency measure of a company, and it tells you how efficiently the company spends their cash. So if they have all of this invested capital, and a lot of growth companies have a fair amount of invested capital, then you want to see the returns they are creating on that invested capital. And if that is very high, then that will be something that you are looking for in a growth stock. Now, at the same time, you want to look for red flags. You want to look for things that may not be indicative of the type of growth stock that will make you returns over the long term. And it will create some riskiness that maybe is not something that you are looking for and may not create the returns that you want to make. Now, some growth investors will argue with me about this, but I think it's very, very important. I talked earlier about how earnings can be something that these types of companies don't have yet. They don't have positive earnings. They don't have a positive net income. They can be operating at a loss. Well, if a company has booked an annual loss for 3 consecutive years, that may be something that you can't overlook. That may be something that you don't want to overlook. Again, this is not a deal breaker, but I don't know if I would be interested in investing in something that did not have positive earnings or had booked 3 straight years of negative earnings. That means there has to be something that is wrong or broken within the business model, at least for now. There is some reason in which that is, and maybe you snuff out that reason and you realize that it's them trying to innovate or whatever it may be, and that they're creating good, those profitability measures. Obviously, not the net profit, but maybe on operating margin, they're providing good profits or whatever it may be. But really look out for that. If there's a company that has had losses over 3 years in a row, it may not be the best thing that you want to invest in. Then, companies that carry a very low market cap. And so for those of you who don't know, the market capitalization is nothing more than the price of the stock times the number of shares outstanding. Okay, and that gives you the market capitalization. And a very low market capitalization would be one under 500 million. Okay, and you may say 500 million, that sounds big. Not when Apple is a $2 trillion company. Okay, so tiny stocks are vulnerable to bigger competitors that can disrupt or threaten them as a company. And this may be something that you really want to look into. Are these industries vulnerable to bigger companies just stepping in and saying, well, hey, we can do that, and doing it cheaper and more efficiently? Now, something that could end up happening is that you end up seeing that a company is doing something that a larger company can't do, and a larger company may want to buy them. Well, that can be beneficial to you as an investor. So in that case, that would be acceptable. Now, a lot of investors feel comfortable in the mid-cap range of investing in growth stocks because that still gives them plenty of room to move forward, but it gives you plenty of track record. It gives you enough understanding of what the company does. It gives you enough of a business model that you could say, okay, these companies can still grow forward. But obviously, if you get too big, then the growth aspect tends to wane quite a bit. Okay, then something else that may be a red flag is that there was a recent management shakeup or a change at the CEO position, and that can really turn a company on its head, especially a growth company that may be planning to do all these things in the future. Well, their whole vision can change just based on a CEO. But maybe a company's vision needed to change, and maybe it changed for the better, and it's actually going to create more value for shareholders over time. So just be wary of that. Then also look and see if sales or profitability is not growing, right? It won't qualify as a growth stock if these metrics of sales, cash flow, earnings, things of the like are consistently falling. We want to see those things rising and rising at an above average rate. So make sure that we're not seeing these waning growth rates, this falling of growth in sales or profitability. And then last red flag that I'll talk about is excessive debt. A lot of companies, in order to try to grow fast and do everything that they want to do into the future, what they will do is take on lots and lots of debt. Well, remember that debt is going to be a hindrance on cash flow. And if we have a lot of debt going into the future, then we will have less free cash flow in the future, which will decrease the market price of a stock today. And it will make it more difficult for the company to operate in the future if it hits any bumps in the road, if it is excessively in debt. And so carrying significant liabilities, right, can get the company into trouble, especially during industry downturns. And industry downturns occur, especially when you're talking about cyclical industries or industries that may be brand new and not very well established in the market, and people may not understand them as well, and their earnings or revenues can really take a hit from time to time. And so if that were to occur, then servicing your debt can be a lot more difficult than ever expected. So excessive debt can be a problem.